Hello and welcome back to yet another video. I hope you are all doing well. Today we are going to take a look at the impact that increasing mortgage rates have on the UK property market and of course prices. Now before we get into the video, please consider subscribing to this channel and of course sharing the video. Now let's get into it. With interest rates rising at their fastest pace in 27 years, inflation still causing the Bank of England and the population of the UK a real headache, a recession looming, is the property market on the verge of collapsing? Well, despite a myriad of headwinds over the last few years, the property market has remained exceedingly resilient. Now, given that whenever interest rates rise, borrowing becomes more expensive, the housing market will be affected in some shape or form. But the big question is, will the recent rise of interest rates push the property market over the edge? Well, in order to come to some kind of conclusion on that, we first need to take a look back at how the property market has fared in times of economic distress. When there are sharp rises in interest rates, we do typically see falls in house prices. For example, in 1978 to 1980, the rise in interest rates led house prices to fall around about 17% between 1980 and 1982. Then, if we go to 1990 to 1992, a rise in interest rates led to falls in house prices of around about 37% from 1990 to 1996. However, it's worth noting that in both 1981 and 1991 to 1992, as well as interest rates increasing, there was also a serious recession, rising unemployment and falling real incomes. So homeowners were being smacked from multiple directions. On the flip side, from March 1984 to June of 1985, interest rates increased from 8.5% to 12.37%. This time, however, it did not cause house prices to fall. In fact, they continued to rise, increasing by around about 10%. And this marked actually the beginning of the Lawson boom, when confidence was through the roof and incomes were rising. Also, the interest rate rises only actually lasted a year. They were cut to 8.3% by the end of 1987. This was arguably, though, a bit of a mistake in monetary policy, later causing a bigger boom and housing bubble. Then, of course, we have the infamous financial crisis. During this period, there was a moderate rise in interest rates from 3.7% to 5.5%, which was followed by a rapid house price crash in 2008, where house prices at their peak fell by as much as 20%. However, in this case, it wasn't actually interest rates that caused house prices to crash. It was the credit crunch. Even when interest rates were cut to 0.5%, the housing market didn't immediately change. Now, as I mentioned above, in both 1981 and 1991-1992, there wasn't just rising interest rates. There was a recession, rising unemployment, and falling real incomes. Currently, we aren't in a recession. Unemployment is not on the rise in any meaningful way yet, and wage growth is at its highest recorded level. But it's worth noting, though, that real pay growth actually remains negative due to continued high inflation. Okay, so now we have some kind of historical understanding of how interest rates have impacted house prices in the past. We can now make an educated guess on what might happen this time round. In order to do this, it's worth thinking about the possibility that we give far too much weight to interest rates and their impact on property prices. Currently, there are roughly 28 million homes in the UK. According to figures from the ONS, the majority of which, 17 million, are mortgage-free. So 6 in 10 homes don't even have a mortgage. Next, we need to consider the total mortgage debt of households that do have a mortgage, and this currently sits at £1.6 trillion. Now, there's no denying that that is an absolutely massive number. However, it needs to be viewed in context. The current value of the housing market is around about £8 trillion. When you think about it like that, it doesn't sound as scary. Basically, the UK housing market has a rough overall loan-to-value of 20%. This obviously isn't spread evenly, but the point here to consider is that there is far more equity in the housing market than there is debt. Where interest rates are having a bit more of a substantial impact is the first-time buyer market. Now, 53% of home purchases with a mortgage are by first-time buyers, many of which are technically just stuck. We also have to consider the 2 or so million homeowners whose fixed rate deal is due to come to an end within the next 1 to 2 years. 2 years ago, you could get a 5-year fixed mortgage for less than 1%. Now, the cheapest 5-year fix is 5.25%, and the majority of people with fixed rate mortgages ending this year are currently fixed at less than 2%, meaning that someone with a £200,000 mortgage jumping from a rate of 2% to a rate of 5.5% will see their monthly payments jump from £848 to £1,228 if repaying over a 25-year period. So, if house prices don't fall and instead they stay relatively flat, should you buy or wait? To make that decision, consider this. There is no 10-year period where house prices have ended up lower than they were 10 years earlier, even if you had bought at the peak of the credit crunch. Since 1939, we've had 69 years where house prices have gone up and only 16 where they've gone down. So if you can afford to buy, you feel secure in your ability to continue making income, and you can pay the mortgage, and you feel like you could live in the property for the next 10 years or more, it is my personal opinion that it's as good a time now as any to buy. But let me know in the comments down below, what do you think? Is now a good time to buy, or are we heading for the mother of all crashes? Let me know down below. But that is all from me. I hope you enjoyed this video. If you did, remember to give it a like, give it a share, and of course subscribe to the channel. I will see you in the next one.